All right, so today I wanted to make a video on how to identify bad dividend stocks slash dividend stocks that may not be bad, but you probably don't want to invest in. And this one is Cal-Maine Foods. This isn't the worst stock in the world, which I'm going to get into, but it's an example I'll get into it. Ticker symbol CALM. Current dividend yield is 9.9%, so very, very nice dividend, but the first thing you want to do with a dividend stock, let's go look at the dividend and the history. The first thing you'll notice, or you should notice, is the dividend is all over the place, right? Recently, it's $5.4 dollars per share, although as recently as later in 2020, it was zero. In 2017, it was zero for the whole year, even the first quarter of 2018. And then going back before that, it was kind of all over the map as well. So we need to look at that and say, okay, well, the dividend on this stock is not only is it not guaranteed, it's almost a certainty that it's going to go down. It's just a matter of when. So the next thing I would do is let's go into the financials here and let's take a look at the financials, because this is the most important thing, because this is what pays the dividend. This is another way to tell if a company is good or not, right? So the first thing that I would check is the free cash flow, right? Well, if we look at the free cash flow, it's all over the map. In fact, it's negative some years, right? 2021, 2020, it was negative. 2017, it was negative, right? So this company is not consistently profitable, right? So that's something you need to understand, is that the dividend on this company is not sacrosanct at all. Like it will be cut at some point, right? If we go into the metrics here, it actually looks pretty good, but that's right now, right? I mean, if we look at the history here, I mean, 5-year stock growth, it's trailing the S&P by a decent amount, so that's something that's concerning. But again, it's really not that complicated. All you have to do is look at the consistency, right? Look at the consistency of the business, right? I mean, I always use CN, for example, right? Canadian National Railway. They are consistent as you can possibly. Now, they're not the best stock in the world necessarily. I wouldn't say that, but that dividend, very consistent. And on top of that, it's a very consistent business, right? And it's a virtually guaranteed business, right? Again, look at this dividend, right? Every single year, year after year after year after year, it's going up, going back 20 years. It is going up every single year. Look at that, right? Historical yield on cost, right? The longer you go back, the higher your yield would be. If you'd have bought this company 20 years ago, you'd have a yield of 29%, right? You'd be getting 29% return per year on that, right? So that is something that you want to look for in a dividend stock, right? How consistent is that dividend, right? Look at the payout ratio, 54%, right? Very safe. So that's something that people really need to keep in mind, right? You're not, like, the dividend right now, it's really not relevant. I mean, it's relevant in that you care about what the number is, but the most important thing is not the current yield. The most important thing, because if you're investing, you're not investing for right now, right? You're investing for the future, right? And if you're investing for the future, well, the main thing is the dividend sustainable? Is the dividend going to go up? Is the dividend going to go down, right? And when you look at a lot of these companies, there's no guarantee, right? I mean, if you look at some of these, the shipping companies, those are super popular, right? NLY, another Annaly Capital, right? These are companies that people love because they got these high dividends, but they're not consistent, right? I mean, look at the dividends going down, right? I mean, if you look at its payout ratio, it's safe, but again, look at it, it's going down over time, right? So yeah, you're getting, what is the current dividend on this? 13.7%, but it's not, I mean, look at the historical yield on cost is lower the further you go back, right? Another very important thing to understand is, I'm not actually sure if this company is an example of it, we're about to find out, is yes, this is an example of it, right? Are they perpetually issuing shares to pay that dividend, right? Because if they're paying you a 5% dividend, but they're adding 5% to the float every year, you're not better off, right? So that's another very important thing for people to understand when it comes to dividends. You got to keep an eye on this stuff. Is the dividend coming from organic free cash flow, not share increases or, unsustainable, levels of growth? I mean, we've seen that recently with some companies, right? They were booming over the last up until 2022 for 2020 and 2021, and then the reality set in, right? So those are just a handful of things. Other things would be like, look at the industry, right? Look at the industry, right? What industry is the company in? Is it in an area that's going to grow? Is it in an area that's safe? Right? That's another very, very important thing that people neglect. And probably the biggest mistake, if I were to cut it down in a nutshell, is chasing yield, right? People see some nice, juicy, high single digit, double digit, even double digit return, and they say, hey, I'm going to get that return every year, when in reality, they probably aren't, right? Again, this is a prime example of it. Number one, the stock price is going down over time. And number two, they're issuing a lot of shares, right? So again, if the stock price is going down, but you're getting a dividend, you're still losing, right? Even if the stock price isn't going down, but they're issuing shares, you're still losing, right? So that's a very important thing to keep in mind that I think a lot of people miss. And even a lot of these bigger YouTubers miss this stuff too. And I'm not going to call anyone out specifically in this name, but there's people I follow that they miss this kind of stuff. They're touting these stocks that really are very subpar, oftentimes because they're the ones that get the clicks, but they're really not telling people about this, right? That this is the important stuff to look for, right? This is the important stuff to look for, right? Stop chasing these subpar stocks. So anyway, that's what I wanted to bring up today. If you liked the video, hit that like and subscribe, and stay tuned for more.